Let's understand what's the reading on the charts. 20K here, but what next now? Gautam Shah joins in on the show for exactly that. Gautam, hi, good morning. Good to have you on the show. Gautam, party coming to an end or has it all just begun?
Good morning. Well, I think the party could take a bit of a pause. I think that's par for the course. We've run really hard on the mid cap, small cap side. I mean, I made this point that the chart of the mid cap and small cap looks like what really happens in mock trading and not in live action. And it's been that flawless, higher high every single day for the last 20, 30 sessions. And I haven't seen something like this in a long, long time. But clearly, round numbers bring euphoria. I think you saw that in the month of July when we got close to 20,000 and got into a correction. Now we are back at 20,000. We've tested it. We've surpassed it. And there is once again euphoria which has made a comeback. So I think what I feel is that the mid caps and small caps could take a bit of a breather, and you're seeing that on the screen today with the downtake. And this could continue for some more time because there is clearly room for some downside. But I think the focus is really going to move to the large caps from here. So the large caps can make up for the underperformance of the last couple of months is what the view is for the next few weeks. And we do see the Nifty gradually moving towards a level of 20,400. I know it's not big in percentage terms, but unfortunately, I don't have large targets to work with because I do believe that the Nifty is going to be in that band of 19,500 to 20,400. And in this period, just stay in specific themes, sugar, textile, IT, pharma, metals, banks. I think these are the themes where I would like to commit into.
Let's first address what's happening on the index, right? Given that we are celebrating 20K. What do you think is going to contribute to the uptick? Because what we've seen is that from the August end to now move has largely been led by underperformers like in HDFC Bank. Infosys has also contributed to the move. And of course, there have been others like in L&T, etc. too.
Well, I think it's going to be the IT index and banks. HDFC Bank has become such a big heavyweight for the market that even a little move impacts the Nifty and the Bank Nifty. And you've seen a good rebound in HDFC Bank from the lows. So I do believe that the Bank Nifty underperformance has come to an end. It is likely to contribute, led by SBI, ICICI Bank, and HDFC Bank. And I do have a working target of about 47,500, which means that the overall market and the Nifty itself should be safe. So banks, I think could possibly lead the up move from here, and followed by the IT index, which saw a lovely breakout a couple of weeks back. Thereafter, we've seen good follow up. I mean, look at what TCS, Tech Mahindra, and HCL Tech have done in the recent past. And we do believe that the IT index can gain anywhere between 10 to 15% from current levels. So Reliance is pretty much in a range. So I don't see too much contribution coming from there. I don't see contribution coming from ITC, but banks and IT is really the focus area for us, followed by metals, which I think is a structural story for the rest of this year. So in this market of 20,000, if you want to buy something which gives you a great amount of comfort with limited downside and great upside, it is metals. The Nalcos, the Tata Steels, the SAILs, and the JSW Steels of the world. I think we are very comfortable buying into them at these prices.
I must flag off what we were talking about, whether the small and the micro caps are headed towards a bit of an ease off. Look at the kind of cool off and the crack that you're seeing within what's happening with the defense names. And if you could just quickly bring up some of these names. The defense stocks are the ones which are seeing a huge crack, by the way. Sugar is falling extremely fast, and the railway stocks as well are easing off quite a fair bit. If you can just flag off some of these intraday names, you have a Mazgaon Dock, for instance, which has seen quite a bit of cool off. IRFC has fallen about 5%. Same can be said about RVNL. That's, I think, cracked about almost 9% or so. Mazgaon Dock, an 8% crack coming in there. And the sugar pack as well. Just yesterday, you saw these stocks actually move up. And today, most of these stocks are undoing all of the gains from yesterday. Gautam, do you believe when it comes to the broader markets, defense, railways, power names perhaps, these are the spaces where you now need to tread with caution and don't hold on if you don't have the stomach or the appetite to manage a 10 to 20% fall?
See, experience has taught me that whenever any rally becomes parabolic, it usually does not sustain. And that's clearly happened in defense and railway. And we have been recommending aggressive profit booking in both these spaces in the last few days. And we continue to recommend the same because I think this is just crazy because people are just factoring in too much into the future discounting too much into the future, which I don't think is right. On the other hand, power, I think, still has a lot of upside left. I mean, look at Tata Power, JSW Energy, CESC, and some of the smaller mid-cap names. I think there it's a more structural trend. I don't think it's got parabolic as yet. So I'm still comfortable holding on to power and buying power on dips. But the other two sectors that you mentioned, clearly, they could actually be topping out, as we speak. So one should be very careful there.
Is it end of the bull market, or this is going to be one of the scary bull market corrections, 20-30%, and before you realize it's actually over?
It could gone are the days when you saw 20-30% corrections in a bull market, because I have seen 2003, 2007, and in that period within a bull market you actually saw 20-25% corrections repeatedly. But please understand that that was a market driven by fraud and liquidity, and we lived in a very, very connected world. This time it's a lot different because it's all domestic liquidity driven. India is an underperformer in the global basket, and we have our own tailwinds as well. So I do believe that there will be thematic rotational correction from time to time. Anything that's overbought will go through its own correction without really impacting the entire market. I mean, mind you, we're in a 6-week long correction on the Nifty. So I don't think it's fair to say that the entire market will go through a correction. I think certain pockets in mid caps and small caps will do that.
No, my question is that if these are bull market stocks, whether it's defense, railways or shipyard, right now in the over near term, they may have become overbought. But on a 15%, 20% decline, if the bull market is intact, would you gravitate towards them only? Or do you think this market action now may just stop them out for many years to come?
I would stay away from them. It's very difficult to say whether I would stay away from them for years, but definitely I think the entire rally is overdone. I don't think it is justifiable with what has happened to many of the railway and defense stocks. Aggressive profit booking is advised. And I think there are just too many pockets in the market where there are much better opportunities based on risk reward. So why do I go back to railway and defense? I think any which way the market has discounted positives 5 years down the line. So I don't see them doing great things anytime soon.
What's the view on the entire consumption space? ITC aside, which you have flagged off, do you believe that there is some steam perhaps in mid-cap names within this space?
No, I think FMCG and consumption in general have underperformed the market in the recent past, and I see that continuing. In fact, FMCG is probably the only sector in the market which hasn't really participated in the recent past and has been languishing. And unfortunately, FMCG is led by ITC and HUL, and both these stocks don't have great charts. So we actually, recommended profit booking aggressively in both these stocks in the recent past, and that continues to be the stance. So consumption, I don't think is really a theme. As I mentioned, I'm more focused into IT, pharma, metals, and banks, where I think the opportunities are clearly there based on risk reward. Everything else, one has to be very, very careful.
For the Nifty also, Gautam, while you did talk about the upper band of 20,400, do you think the aberration and the volatility could get heightened from here? I mean, for instance, we've already fallen almost 1% from the top. We're at 19,941 now on the index.
See, I think volatility is good for any bull market. Whenever you see a rally which is vertical in nature, it is usually not sustainable. So I'm happy to see volatility, to be honest, to the tune of 2-3%, which is absolutely normal. This is something that you saw in the last 6 weeks. But I remain of the view that on the index, there are no signs of topping out on the charts. You could see these 100, 200, 300 point knee-jerk reactions that might scare market participants that maybe the best is over, but I don't think that's going to be the case for the index and large caps. It's really pockets within the mid caps and small caps where you need to be careful and invest and trade carefully.
So if the correction has to kick in, let's say in mid and small cap stocks, what could be the extent?
A lot of stocks have actually gone up 2x, 3x, 5x, just like that in the last 12 to 18 months. So there could easily be a 20 to 40% kind of a drop in many of the high flyers of the last 6 to 12 months. So that, traditionally, that's the kind of correction that you see. In technical analysis, we talk about a 38% or a 50% retracement of the entire rally. I think that can easily happen in a lot of stocks. But even within the mid-cap space, I think sugar has broken out recently, fertilizer has broken out recently, cement continues to look good to us, auto ancillary continues to look good to us. The entire unlock basket, the QSR space looks good to us. So you can't, paint everything with the same brush. These are pockets that we like, and there are some pockets that we dislike. So it's going to be a very stock-specific market. You just can't holistically buy anything and everything, which has been the case for the last 2 months.
2 points lower, 19,943 now. So flattered for a bit, and then that crack has come in. So let's talk about individual stocks then, Gautam. If you could just highlight 3 buys and 3 sells from your end.
Well, as I said, I am, oscillating towards the large caps. I feel at a 20,000 index, they are far more safer. So I would refrain from giving out any mid cap or small cap name at these levels. But within the large cap space, I think in the IT space, we continue to like HCL Tech, Tech Mahindra, and TCS. And I believe that all these 3 stocks could appreciate anywhere between 10 to 15%, a visibility that you don't have for many large cap stocks in the market. So that's number 1. Number 2, I think from the metal space, we like the way Tata Steel has set up. I think it could do something special over the next 3 to 6 months. So large upside to the tune of 20-25%, followed by Nalco and JSW Steel. So these 2 sectors and the 6 stocks that I mentioned would be my top picks among the large caps.
Closing comments. Before the year end, will Nifty be higher from current levels or lower from current levels? It's an easy one, right?
Yeah, I know it's an easy one, but I think we should be higher, but I don't think we are going to be too much higher from where we are right now.
Settle between, let's say, 19,000 to 21,000. That would be a fair assumption?
That's a very fair assessment, Nikunj. I think if we can just stay in this sort of a band and just pass the entire year, I think that's great for stock pickers like us.
Gautam, before we let you go, I just wanted to ask you about New Age Tech. Has that been a missed opportunity, or is that something that you have no FOMO about?
Well, New Age Tech is an opportunity selectively. I think we've been a big bull on Zomato all along. We just like the way the chart setup is. And I do believe even from current levels, it could do special things if you have a time frame of 12 to 18 months. At the same time, stocks like Nazara, stocks like Delivery, I think, are on top of our list. So again, don't look at anything and everything. The few names that I mentioned is where we are highly convinced that it should do well over the next 12 to 18 months.
Thanks much for joining in. Good to have you and get perspective.